Welcome everyone to the KPMG Accounting and Reporting webinar series for 2022, 30 June 22 reporting part 1. I would now like to hand over to your host, Kim Heng. Kim, over to you.
Thank you. Hello, I'm Kim Heng, a partner in KPMG's Department of Professional Practice. It's a group that helps clients and KPMG staff with interpreting and applying IFRSs and other financial reporting requirements. Joining me today is Joe Wheeler, our director, and Oksana Glechenko, a senior manager within the firm. COVID-19, natural disasters, world events, and inflationary pressures are just some of the major issues driving global economic uncertainty today. This evolving uncertainty creates a variety of issues and risks, including supply chain disruptions, staff shortages, and increased market volatility. With the formation of the International Sustainability Standards Board, ISSB, in November last year, an issue of proposals on the first IFRS Sustainability Disclosure Standards in March 2022, the focus on climate-related risks and opportunities in annual reports has increased with amazing speed. There is also the OECD's inclusive framework on base erosion and profit shifting that sets a framework for reforming the international tax system to consider. International and local standard setters are also still very active and have a full agenda, including the development of amendments and clarifications from the IFRS Interpretations Committee. Finally, the new framework for-profit private sector entities is effective, which brings an end to special purpose financial statements for a number of organisations. That is, the removal of the reporting entity framework, which we've been working with for the last 30 or so years. As such, we have developed our webinar agenda in this reporting context. Which we've split over 2 sessions for you. Today, Joe will take you through a regulatory update discussing what ASIC's focus will be in its upcoming financial statement surveillance program. Oksana will remind you about the applicable changes to the Australian reporting framework. I'll take you through our hot topic on BEPS 2.0, and Joe will discuss how uncertainty in the economic markets can impact your financial statements. Then I'll come back, wrap things up, and all of us will respond to your questions. So we will be doing a Q&A on the content presented. Therefore, if you have any questions, then please submit them using the Q&A function, and we'll try to address as many of them as possible at the end of the webinar. Next week, we'll continue our webinar series and we'll focus on new accounting standards effective and available for early adoption this 30 June year-end and half-year, and the more recent IFRIC agenda decisions. We'll also spend some time on the topic of climate-related risk disclosures. As usual, we will be uploading a recording of this webinar and the slides to our external website where you'll be able to access them. Whilst this webinar is focused on the impacts on for-profit organisations, although some of the items we will discuss does impact not-for-profits, if you are also interested in understanding specific not-for-profit considerations for this 30 June and missed our webinar on the 3rd of May, then the recording and copy of the webinar slides is available on our website. I'll now hand you over to Joe.
Thank you, Kim. And again, welcome all. As Kim introduced, I'll cover the regulatory update first. Let's start with ASIC's Financial Statement Surveillance Program. The most recent results that we have for the ASIC Surveillance Program is from 30 June 2021. We expect the results of the 31 December 2021 program to be released sometime this coming June. For 30 June 21, ASIC reviewed the financial reports of 150 entities and made inquiries of 29 of those entities on 53 separate matters. The chart on this slide shows the areas where the inquiries were made. The top 2 areas of focus remain consistent with last year, being impairment and expected credit losses in the operating and financial review. We'll expand on these areas in the next slide. Revenue recognition, tax accounting, and expense deferral all saw increases in inquiries compared to 31 December 2020. While revenue recognition questions continue to decrease as we move further away from the adoption of the revenue standard, it remains a key area of inquiry. Those inquiries varied from the nature and recognition of fees and services for financing arrangements to the timing and recognition of online sale of goods. Tax accounting inquiries largely related to the recoverability of deferred tax assets and the reasonableness of future taxable income to recover tax losses, both of which are often accounting estimates for companies. Later in this session, we'll spend some time discussing the impact of accounting estimates in the uncertain times that we're living in. In addition to revenue and taxes, expense deferral also made up 11% of inquiries. These mostly resulted from poor disclosure. In particular, there were inquiries when there was an increase in software intangible assets with no disclosure of whether the recent IFRIC agenda decision would result in material amounts of costs being recognized. We'll provide a reminder on that IFRIC agenda decision during our second webinar, which Kim mentioned earlier. We wanted to dive a bit deeper into the two main areas of inquiry, the first being considerations for impairment and expected credit losses. Let's start with the impairment of non-financial assets and some key reminders. Consideration of the reasonableness of key assumptions is always an extremely challenging area in financial reporting. While we cover the impacts of uncertainty on financial reporting later in this webinar, we wanted to remind everyone of the importance of reassessing key assumptions, including in cash flows, based on the current economic conditions that are impacting organizations. Organizations will also need to take a fresh look at discount rates used, particularly in light of rising interest rates globally. The last consideration is whether there are new or continuing indicators of impairment that must be considered. For example, organizations should consider the recent flooding across East Coast Australia and the short and long-term impacts this has on their operations. The considerations for expected credit losses, or ECL, are similar. What's new is that customers that previously may have had strong balance sheets may now be facing liquidity issues. For instance, delays in global shipping time has caused significant pressure on supply chains. There is a potential flow-on impact to payments while delivery of products and services lag due to these delays. With that in mind, it's important to consider the current financial conditions of creditors and not always rely on the historical accuracy, especially when the historical results may not be indicative of the current ability to make payments. As you can see here on this slide, there are also a number of other assets to consider for impairment. As an example, significant changes to global real estate are impacting the key assumptions and property values, and also right-of-use assets where property is leased. These changes include changing in office space requirements in major cities and the overall impacts the economy has on tenants. For all of the assets listed on this page, it's important to remember that disclosure is key. Preparers should ensure that there is appropriate disclosure of estimation uncertainties and include disclosure when changing key assumptions, which is more likely in the current environment. Next to impairment, the OFR was the next highest level of inquiries. ASIC continues to emphasize how critical the quality of financial reports and related disclosures are for keeping investors informed. Given the ongoing uncertainty presented by COVID-19 and other global events, these disclosures have heightened significance for users. Organizations must continue to ensure that markets are properly informed about underlying drivers of results, future prospects for businesses, and also business risk. ASIC continues to highlight the important role the OFR plays in providing this information to the users of the financial reports. Working out what disclosures to make will require careful deliberation of how much disclosure is appropriate. While we often see examples of too little disclosure, there are some scenarios where too much disclosure can hide or bury material information for investors. Another common area of inquiry relates to discussion of the impacts of events that are far too generic. To solve this, organizations should try to provide detail as to how global impacts like COVID, the conflict in Ukraine, and general market uncertainties are impacting their business in a granular and factual level. An example of this is that certain segments or geographies may be more or less impacted than others. Another consideration is where companies also acknowledge where events have strengthened their business. Historically, we've seen that disclosures are often weighted on the negative impacts on the business. In summary, disclosure that's specific to your company, transparent, and evenly balanced between positive and negative weightings are the most useful to investors. To wrap up this slide, we wanted to remind you that the OFR is meant to be consistent and complementary with those disclosures in the financial statements. An example of this is providing further context to articulate the uncertainties in the financial statements, and it's important when this information is not already disclosed in the financial statements. We have discussed a number of these already, but we wanted to acknowledge some of the other focus areas and where additional assistance can be found. In applying the leases standard, both lessees and lessors should consider the accounting treatment of rent concessions and the impairment of lessee right-of-use assets. We have a separate publication on rent concessions available for use on these topics. One other important focus area that we haven't touched on is related to non-IFRS profit measure disclosures and ensuring that they're not presented in a potentially misleading manner. Kim, just to bring you in for a minute, before I move on to discussing bed licenses, is there anything that you've seen that directors and management should be considering when reviewing non-IFRS disclosures?
Joe, organisations should continue to remind themselves of the requirements of ASIC's regulatory guide dealing with non-IFRS financial information. So that's RG 230, and ASIC's specific comments about non-IFRS measures that they've included in their FAQ. The other thing to note is that having had to live and deal with COVID now for about 2.5 years, organisations should really question whether COVID impacts should really continue to be non-IFRS adjustments, as much of the impacts are becoming business as usual. As a reminder, RG 230 considerations include making sure that the non-IFRS measure is appropriately reconciled to the IFRS measures and presented in a potentially misleading way, and the consistency of adjustments period on period. For example, have we ensured that any reversals of asset impairment losses is excluded from non-IFRS measures when the impairment loss itself was originally excluded from that measure in a previous period? So back to you, Joe. Thank you.
Yeah, thanks. And I'll move on to the next topic, which is bed licenses. While accounting for bed licenses may not have a pervasive impact on a number of you on the call, it will have a significant impact for those in the aged care industry. As a brief summary, the most recent federal budget announced a decision to discontinue aged care approval rounds following the 2020 rounds. What that means is that from 1 July 2024, aged care places, which are also known as bed licenses, are set to be allocated directly to senior Australians rather than past practice in the current model, which assigns those places to aged care providers. Further announcements regarding this change in policy were released by a Department of Health discussion paper this past September. On the back of the discussion paper, ASIC also released an FAQ response regarding the accounting for these bed licenses. ASIC's FAQ covers two main areas. The first topic is on the amortization of bed licenses. ASIC's view is that bed licenses should be amortized over the period to 1 July 2024, as the useful life of bed licenses is now finite. The change in useful life should be treated as a change in estimate and applied prospectively from 1 October 2021. This is the date immediately following the release of the discussion paper that I mentioned earlier. The other key topic is whether an impairment indicator arises and that the licenses should therefore be tested for impairment. The answer to this is yes. In testing for impairment, the bed licenses would continue to form part of a CGU assessment unless it's separately held for sale. To wrap up the regulatory update, ASIC had the following focus areas at 31 December 2021. We expect the 30 June 22 focus areas to be released in the next month or so, but it's worth noting that we don't expect any significant changes to what's shown here. Our publication on ASIC focus areas has a detailed appendix to assist organizations in assessing these in more detail. The appendix includes questions to prompt management to determine whether there are any changes or improvements that can be made in these areas of financial reporting. As for the items here on this slide, we've already covered asset values and disclosures in detail, and we'll cover going concern in a later slide. For provisions, it's important to ask whether your company has considered if any contracts, in particular revenue contracts, have become onerous. You might also consider whether you need to be recognizing a provision for restructuring. In doing so, it's important to consider if there's a formal restructuring plan in place at the balance date, which has raised a valid expectation in those affected that the entity will carry out the plan. Lastly, for subsequent events, for nearly all recent reporting periods, there have been global events that have straddled the reporting period. Where we're hoping for a quiet 30 June, to the extent events occur, the first assessment is determining if those events are adjusting or non-adjusting subsequent events. To the extent that they are adjusting, you must adjust accounting estimates and judgments where events affect the valuation of financial and non-financial assets. For non-adjusting events, disclosure is key to ensure that a user of the financial statements is aware how the events will impact your organization into the future. And with that, I'll hand it over to Oksana to discuss other Australian issues.
Thank you, Joe. We now have a new Australian financial reporting framework for for-profit private sector organizations that effectively brings an end to special purpose financial statements for a number of them and is required to be adopted for reporting dates on or after 30 June 2022. So this is our last chance to ensure that this topic is well understood by all. The existing Reduced Disclosure Requirements regime, or RDR, is being replaced with a new Tier 2 Simplified Disclosures framework. Organizations currently preparing special purpose financial statements will likely need to make more disclosures under the new regime than they do now. However, the new regime has fewer disclosure requirements overall compared to the existing RDR framework. For now, the not-for-profit private sector organizations will continue to follow the old framework until the ISB finalizes a project which aims to adopt the new framework for NFPs. At present, we expect this to happen either later 2022 or in 2023, and we will issue additional publications as this ISB project proceeds. So with this in mind, let's for the last time step through the main considerations of the new Australian private sector financial reporting framework. The old framework focused on public accountability and reporting entity concept. If an entity has public accountability and is required by legislation to prepare financial statements in accordance with Australian accounting standards, then it must prepare General Purpose Tier 1, and this has not changed in the new framework. If an entity does not have public accountability, then we will no longer assess whether the entity is a reporting entity, and this is the main area of change. If the entity is required by legislation to prepare financial statements that comply with Australian accounting standards, they will now be required to prepare and lodge a form of general purpose financial statements. This means that for-profit entities regulated by ASIC, for example, large proprietary companies or small foreign-owned companies, who may be currently preparing special purpose financial statements, will need to prepare and lodge a form of general purpose financial statements going forward. So let's look into an example. Both Company A and Company B are for-profit, large proprietary companies without public accountability and ultimately controlled by a foreign parent entity. There is no deed of cross guarantee in place, and both companies have no relief from preparing financial statements. The question is, what type of financial statements are required to be prepared by Company A and Company B for 30 June 2022 year-end? As we discussed on a previous slide, for large proprietary companies that do not have public accountability, They are required by the Corporations Act to prepare and lodge financial statements that comply with Australian accounting standards. As such, both Company A and Company B will need to prepare General Purpose Tier 2, unless they voluntarily elect to prepare General Purpose Tier 1. However, one more question to respond here is whether they are required to prepare consolidated financial statements or not. This will depend on whether it is an ultimate or an intermediate Australian parent, with reference to respective paragraphs in ISB 10 as listed on a slide. The wording in the standard has been updated and no longer refers to reporting entities. This update means that if the ultimate Australian parent is required by legislation to prepare financial statements that comply with Australian accounting standards, then consolidated financial statements are required. So in our example, Company A, as the ultimate Australian parent, will be required to prepare consolidated financial statements. Company B, as the intermediate Australian parent entity, can still utilize the exemptions provided in the standard and not to present consolidated financial statements. Moving on through the diagram. For those entities not required by legislation to prepare financial statements in accordance with accounting standards, the next focus will be on the requirements in their constituting document. For example, constitution, trust deed, or partnership agreement. The most common example of such entities would be a unit trust. Where a document requires financial statements to be prepared in accordance with Australian accounting standards, special purpose can no longer be prepared if such document is created or amended on or after 1st July 2021. I will come back to the meaning of this 1st July date on the next slide. Where the relevant document make references to, say, accounting standards or commercially accepted accounting principles or generally accepted accounting principles and the Corporations Act or something similar, our expectation is that the directors will need to determine the meaning of that phrase. And if this meaning is not clearly defined in the document, legal advice should be considered in forming a documented view by a company. As I said before, requirements to prepare general purpose financial statement apply only for entities when a constituting document was created or amended on or after 1st July 2021. This concession was made by ISB, where a grandfathering exemption was provided to entities which are required by their constituting document to prepare financial statements in accordance with Australian accounting standards, and their constitution or other document was created or last amended before 1st July 2021. The exemption effectively provides that the entity is not required to prepare general purpose financial statements, but it can still voluntarily elect to prepare it. This concession has no technical basis, but rather is a cost-benefit standard setter accommodation for first-time adoption. This exemption is lost where the constituting document is amended on or after 1st July 2021 for any purpose. The entity may have the ability to remove the requirement in the document to prepare financial statements in accordance with Australian accounting standards. However, when the document is next updated, and I want to highlight again that it doesn't matter in what extent this was updated and for which purpose, a change to the requirements to comply with Australian accounting standards will need to be considered. We provided some possible scenario on a slide that you can look into your own time to illustrate this 1st July rule for amending constituting documents. If there is no legislation or constituting documents that requires financial statements to be prepared in accordance with Australian accounting standards, and the entity does not voluntarily elect to prepare general purpose financial statements, then the directors will need to establish a process for a basis of preparation by consultation with users and consider all users of the financial statements. This process will need to be robust and documented as part of the entity's normal governance procedures and also should be reconsidered each time the entity prepares financial statements, which makes it not an easy exercise. Kim, does KPMG have a particular view on a decision whether organizations should voluntarily elect to prepare general purpose Tier 2 or go the user-defined financial statement route?
Yes, Oksana. KPMG does have a preferred position on this. Overall, we believe that user-defined financial statements should be on par with general purpose Tier 2 simplified disclosure financial statements. This is because of the perceived deficiencies of some special purpose financial statements, which has already led to increased demand for related party and income tax disclosures. Also, we know that when the AASB set the disclosures required in 1060, they had indicated that these were a set of minimum sets of disclosures that financial statement users would require. And also, in order for your auditors to sign off a presents fairly opinion, then we believe this information, this additional information should be included in the user-defined financial statements at a minimum. Therefore, given that general purpose Tier 2 simplified disclosure better manages your risks around financial reporting governance issues, and any user-defined financial statements that continue to be prepared will have more disclosures than that was previously included in special purpose financial statements. We do think that the better cost-benefit solution is to prepare general purpose Tier 2 simplified disclosure, regardless of what your constituting document says.
Thanks for that, Kim. So, if you're applying IASB 1060 for the first time for your 30 June 2022 year ends, you now have to look at one standard for all your disclosure needs. It is important to note that full and proper comparative disclosures are required when adopting from the mandatory effective date, meaning that if separate financial statements were prepared previously and consolidated financial statements are prepared now, that all comparative information needs to be presented and on a consolidated basis. However, entities will still be able to apply the transition elections in IASB 1. More information on the transition disclosure requirements could be found in our Example Simplified Disclosures publication. It should be remembered that IASB 1060 sets out the minimum disclosures, so the entity still needs to consider any additional disclosures required beyond IASB 1060 in order to achieve fair presentation. Also, entities will continue to follow all other standards for recognition and measurement requirements. And finally, a reminder that KPMG has developed an interactive web page that contains useful resources on the new Australian financial reporting framework and could be helpful for your transition. I will now hand over to Kim to take you through BEPS 2.0 topic.
Thanks, Oksana. But before I delve into the rules of BEPS 2.0, I thought it'd be worthwhile to provide you with some background on the evolution of this global tax reform. Over a number of years, we have seen news headlines similar to the ones that I've shown you on screen, raising concerns about large multinational corporations paying, or should I say, not considered to be paying their fair share of taxes in the jurisdictions in which they provide their goods and services. The core issue underlying these cases is what's referred to as base erosion and profit shifting, BEPS for short. The ATO defines BEPS as those tax planning strategies used by multinational companies to exploit gaps and differences between the tax rules of different jurisdictions internationally. They also note that these strategies are undertaken to shift profits to low or no tax jurisdiction where there's little or no economic activity. The OECD has estimated the annual revenue loss for governments due to BEPS is between US 100 and $240 billion. Now, a key point to note here is that most of these strategies are in fact legal, and that is why global tax authorities have been looking to introduce rules that close these legal loopholes that allow those strategies to persist. And BEPS 2.0 is the OECD's second shot at meeting this objective with the BEPS 1.0 rule published in 2015. The BEPS 2.0 rules themselves represent an international agreement on a two-pillar approach to a global tax reform, and some 137 jurisdictions have signed up to BEPS 2.0. The first pillar of the new rules seek to reallocate a multinational's profit and taxing rights to markets or end-user jurisdictions, regardless of whether the organisation actually has a physical presence in that jurisdiction. This pillar looks to address the challenges associated with the digitization of our global economies, as existing international tax rules, which are primarily focused on physical brick and mortar economies, is actually no longer seen as fit for purpose. The second pillar introduces a new global minimum effective tax rate of 15% to try and level the playing field associated with tax competition across different jurisdictions. Each of the two pillars contain a set of rules that's targeted at multinationals of different sizes, and together do represent one of the most significant reforms to international tax system in over 100 years. These reforms, as you will see, will have financial consequences, which is why we believe now is the right time to raise awareness of these reforms beyond the corporate tax function. So, Pillar 1. Pillar 1 seeks to reallocate taxing rights to the jurisdictions in which the end user of the organisation's goods and services is located. It applies to large multinational groups that have more than Euro 20 billion of global turnover and profitability above 10% of revenue. As these thresholds are it's expected to impact over 100 global groups, but very few, if any, Australian groups, given that the extractive and regulated financial services industries are proposed to be scoped out of this pillar. Pillar 1 will require 25% of a multinational group's profits above 10% profit margin to be allocated and taxed by jurisdictions where the group has digital users, regardless of whether the group has a physical presence in that jurisdiction. Pillar 1 is also expected to introduce new transfer pricing rules that will be applicable across all multinational groups. Given that this pillar is not expected to have a significant impact on Australian groups, that's exclusive of the transfer pricing changes, we won't be exploring this much further today. Pillar 2, though, on the other hand, is expected to capture thousands of groups globally, with many Australian groups in scope, given that it does apply to groups with more than Euro $750 million in global revenue. Under Pillar 2, organisations will have to pay a top-up tax for any jurisdictions with an effective tax rate below 15%. And the amount of this top-up tax is actually paid by the ultimate parent to the ultimate parent's tax authority, and it's the top-up tax that will bring the effective tax rate up to 15%. Now, there are a number of additional rules that make up the complete Pillar 2 package, but many of these are expected to be more limited in their impacts. So really only going to focus on this minimum tax rule today. So let me take you through an example of how Pillar 2 could work. So here we have an ultimate Australian parent company with subsidiaries in 2 jurisdictions. Under existing tax legislation, the corporate income tax rate applicable to each jurisdiction is 30% for Australia, 0% for jurisdiction 1, and 21% for jurisdiction 2. Now, under existing tax laws, the parent and each subsidiary in jurisdictions 1 and 2 are taxed by their local tax authorities at their respective corporate tax rates based on the income tax laws applicable to them in their respective jurisdictions. And there's no additional income taxes that are paid by the consolidated group. Under Pillar 2, though, in addition to the taxes payable under existing tax legislation to the Jurisdiction 1 and Jurisdiction 2 tax authorities, the ultimate Australian parent will need to determine if any additional top-up tax is payable. This involves combining the results of all the subsidiaries in Jurisdiction 1 to determine the effective tax rate for that jurisdiction, and then doing the same exercise for Jurisdiction 2. So in our example, after doing this, the ultimate Australian parent determines that the effective tax rate is 29% for Australia, 0% for Jurisdiction 1 subsidiaries combined, and 15% for Jurisdiction 2 subsidiaries combined. And let's assume that the Jurisdiction 2's effective tax rate is significantly below the corporate tax rate of 21%, largely due to certain tax incentives that that jurisdiction offers the subsidiaries. As a result of this calculation, a top-up tax obligation exists for Jurisdiction 1 under Pillar 2, as its effective tax rate is below 15%. And it's the ultimate Australian parent who will have to pay this top-up tax to the ATO and will bring the tax paid for Jurisdiction 1 subsidiaries up to the effective tax rate of 15%. Now, clearly this top-up tax is an additional tax outflow for the group and an increase in the cost of doing business in Jurisdiction 1 compared to pre-Pillar 2 world. So why is now the right time to start thinking about BEPS Pillar 2 and how it might impact your organisation? First of all, the start date for the reforms could be as early as 1 January 2023, though it could be deferred by some or all countries by at least 12 months. Even if the start date is deferred until 2024, there's still a lot of work that needs to be done in 18 months for impacted organisations to get ready for these new rules. Also, as soon as a multinational has one operation in a jurisdiction that enacts the Pillar 2 legislation, the whole multinational group will likely be caught by the rules, meaning that you do need to stay vigilant and be ready to go on these changes. Secondly, in an effort to retain the additional top-up tax revenue in local tax jurisdictions, some countries are expected to make changes to their local tax laws. In our previous example, in Jurisdiction 1, where the effective tax rate is below 15%, Jurisdiction 1 tax authority may consider changing their tax laws, for example, by increasing their corporate tax rates so that they do not miss out on the top-up tax that is being paid by the ultimate parent to the ATO. But unfortunately, even if they do this, this will not remove an organisation's compliance obligations under Pillar 2 for that jurisdiction. Instead, this will add another layer of complexity as organisations will need to monitor local legislative responses as well as prepare to apply Pillar 2 and adapt to changes as required. Thirdly, the rules are complicated. The tax payable under these rules are in addition to existing tax laws and involve complex calculations which often need information to be gathered, manipulated, and presented annually in ways that an organisation may not have done so before. On this slide, I've extracted for you a simple summary of the calculation of the effective tax rate and the top-up tax to put this into context. This information gathering and tax calculation exercise will likely require new processes which involve finance and tax personnel to establish, and this can take time to set up. And let's not forget, there will be accounting consequences to consider. It's likely that Pillar 2 will be in the scope of AASB 112, the income tax standard. Where this is the case, the organisation will need to consider what current and deferred tax consequences arise from the application of these new rules and when they should be recognised. Remembering that deferred taxes are measured at tax rates that are expected to apply when the underlying asset or liability which gives rise to these timing differences are realised. And this is based on substantively enacted tax laws at the period end. So if these tax laws are substantively enacted prior to 1 January 2023, then there could actually be accounting consequences recognised by 31 December 2022, or maybe even earlier. Further, with the complexities of these proposed rules, there may actually be additional income tax uncertainties that need to be considered and accounted for going forward. Much of this will take time to work through, and your auditors will need to be taken along on the journey. Further, your stakeholders will want to understand these potential exposures and the impact of these new rules. So you're going to have to provide sufficient disclosures to your stakeholders on this implementation journey. So having said all of this, what should you do now? We recommend that organisations start conversations between the finance and tax function and begin to form a view on whether they are likely to be in scope of the BEPS 2.0 rules, particularly Pillar 2, and identify higher risk jurisdictions where exposures for additional taxes might exist. In order to do this, the tax team will need the support of the finance team in gathering the financial data that combines the results of all the subsidiaries within each jurisdiction. And this information might not have been collated or presented in this way in the past, and may identify information or data gaps which will need to be filled to support your organisation's Pillar 2 ongoing compliance activities. And clearly, finance data underpins the determination of jurisdictions, of each jurisdiction's specific effective tax rate and taxable income. This data gathering exercise may highlight changes to systems and processes, technologies that are needed to enable compliance, as well as changes to legal and operating structures, which may no longer be fit for purpose, possibly resulting in restructurings. Finally, as the BEPS 2.0 rules are likely to increase future tax obligations and uncertainties for certain groups, impacted organisations should consider disclosing information about possible BEPS 2.0 exposures in their 30 June 2022 financial statements and the Director's report, specifically in the OFR. More information can be found on our website, and a good place to start is our BEPS 2.0 Key Considerations for CFOs, which provides an overview of the key considerations relating to the BEPS 2.0 plan, proposed legislation, as well as a high-level checklist of things to start considering today. I'll now pass you back to Joe, who will take you through our second topic for today.
Thank you, Kim. Our next and final hot topic is considering the impact of uncertainty on financial reports. We're living and working in times of significant global economic uncertainty and volatility. The conflict in Ukraine and related impacts are likely to increase the effects of an already volatile market. Many sectors and jurisdictions were already facing increased raw material costs as a result of surging consumer demand as the COVID-19 pandemic eases. Now we grapple with the natural disasters like the recent flooding in Queensland and New South Wales. On top of this, supply chain bottlenecks arising from the effects of the pandemic continue to persist and are heightened by labor shortages and trade friction. Many sectors also face high staff turnover and staff shortages. These uncertainties have broad impacts on financial reporting and are very much tied into the regulatory focus areas that we covered earlier. In these uncertain times, we think one of the first key questions to ask is whether any of these uncertainties a trigger for impairment testing. Take the Russia-Ukraine conflict, for example. Even if your organization does not operate in Russia or Ukraine, we expect that all companies will be impacted in one way or another by the conflict. To give a few examples of sector-specific issues, the banking and financial services industry are all likely to be impacted by potential losses of customers due to currently imposed sanctions, as well as potential increases in costs to comply with the current restrictions. Other industries like the airline and shipping industries are impacted as well. Their operational impacts include diverting a number of common routes for both industries that are not currently available. This may impact whether certain routes must be lengthened or simply not operational at all, again leading to increase in costs for these industries. Conversely to this, other industries may see indirect positive impacts. These impacts include increases in commodity and agricultural products. Russia and Ukraine are estimated to produce approximately 30% of the world's wheat supplies, and the impact on the conflict on pricing has been significant. The impairment standard requires a company to assess at each reporting date whether there is any indication of impairment or conversely an indication that a previously recognized impairment loss should be reversed. When a triggering event has occurred, management needs to determine the recoverable amount. The recoverable amount for an asset or cash generating unit is the higher of value in use and the fair value less cost of disposal. Determining this amount usually requires management to forecast future cash flows. Significant assumptions such as forecast sales, growth rates, and inflation rates will need to be reassessed and updated as appropriate due to the significant changes in economic and market conditions. The last point on this slide is related to the discount rates used in forecasted cash flow models. The discount rate should be updated to reflect the impact of changes in interest rates in the risk environment at the reporting date. We'll now cover two other specific areas of financial reporting that are impacted by global uncertainty. The first point I'll cover is related to the going concern assessment. Management needs to assess whether these global events or conditions may cast significant doubt on the company's ability to continue as a going concern, or in some severe cases, whether the going concern assumption is still appropriate as a basis for the financial statements. Although some sectors and jurisdictions are more affected than others, all companies will need to consider the potential implications for this assessment. When assessing the company's ability to continue as a going concern, the first step is to update forecasts and sensitivities, taking into account the risk factors identified and the different possible outcomes. It's important to consider at least one severe but plausible downside scenario. In these scenarios, a company should also review projected covenant compliance. To the extent there are events or conditions that may cast significant doubt, organizations must consider the plans to mitigate these risks. In particular, management would be expected to reassess the availability of financing and whether its plans are achievable and realistic. As you might be sick of hearing by now, disclosures around going concern are especially important to achieve transparency and provide users with relevant information. As for the other items listed here, the recognition of liabilities and assessment of owners' contracts needs to be done, as we mentioned in the regulatory update earlier. This means that in such circumstances, some existing purchase or sale contracts may become loss-making and ultimately require a provision to be recorded. We do, however, remind you that a provision is recognized only for an existing present obligation and not for future operating losses. I'll also touch on the last point on the slide, which is the classification of debt. We've seen a number of loan agreements that include subjective covenant clauses that are sometimes referred to as material adverse change clauses. Organizations will need to exercise judgment in determining whether those subjective clauses are breached. In tying this back to the going concern assessment, even if a breach has not occurred by the reporting date, companies will need to assess their ability to maintain compliance with debt covenants in the future. As you can tell, there are a number of impacts on uncertain times all the way across financial reporting. While we can't cover each area on this slide in detail, set out here are other areas to consider. On the next slide, we will show you where additional resources can be found. To highlight a few more broad areas on this slide, I'll start with a few reminders related to revenue accounting. In the current environment, we've seen examples where customers are being offered new incentives to boost consumer demand. In these scenarios, you'll need to consider whether that would reduce the estimated amount of revenue being recorded. Another area of significant estimation uncertainty is when a company transfers control of a good or service over a period of time. This is common in sectors such as real estate and engineering. A company applies a single method of measuring progress in transferring control of goods or services using either an output or an input method. When a company uses an input method to measure progress, it needs to estimate the total expected inputs that will be needed to satisfy the performance obligations. A number of issues we've discussed here may impact project timelines if work cannot be completed to the originally planned schedule. It may also push up the cost of key inputs used. In these scenarios, companies need to ensure that the estimated progress and the revenue recognized reflects the latest expectations. Any changes in these estimates should be accounted for prospectively. If I stay with revenue but stepping away from estimates, if a company's supply chain or labor force is disrupted such that it can't satisfy its performance obligations, then this could result in penalties that reduce the transaction price and also impact revenue. In addition to revenue, there continues to be a number of considerations related to lease contracts. Lease contracts containing renewal and termination clauses may need to be reassessed to determine whether there is a change to the lease term. Any changes in the lease term could have a significant impact on the carrying amount of lease assets and lease liabilities. As a reminder, IFRS 16 requires a lessee to determine whether they are reasonably certain to exercise an option to extend the term of the lease, or conversely, not to exercise an option to terminate the lease early. In doing so, lessees consider all relevant facts and circumstances that create an economic incentive for them to exercise an option or not. An example of this is when retailers conclude that revised commercial plans developed in response to an uncertain environment triggers a reassessment of renewal options in its store leases. In assessing whether it's reasonably certain to exercise the renewal options, the retailer considers the economic incentives at the date of the reassessment. We acknowledge that that's a lot of information to consider, and in some cases, we're just scratching the surface. KPMG globally has organized all of our resources related to uncertain times in one place, which you can easily find on the internet by searching KPMG Uncertain Times. Each topic that we've discussed here has a detailed publication to assist you in the first instance with considerations as we approach 30 June. And with that, I'll hand it back over to Kim to wrap up, and then we'll open it up to questions.
Thank you, Joe. As you plan for your 30 June 2022 year end and half years, we've listed here for you the key takeaways from today's webinar. In the interest of time, I won't go into detail as to each of these points, and we'll leave them for you to consider. And here is our agenda for part 2 of our webinar, which will be running next week, where I hope you'll be able to join us. So we'll now spend a little bit of time looking at the questions that you have been submitting. Okay. Thank you for submitting your questions, and we've received a number of them. I'm hoping that we can get through, we're probably not going to get through all of them, but I'm hoping that we can get through a number of them. Joe, there's one here for you around the reversals of impairment. So you talked about reversals of impairment towards the back when you talked about uncertain times. I mentioned it a little bit when I talked about non-IFRS financial information. The question here is, what is the journal entries for the reversal of impairment losses?
Yeah, thanks, Kim. The journal entry is generally going to be a credit to the P&L. I say generally because there could be scenarios where the asset that was impaired is an asset that's revalued through equity, in which case that wouldn't go back through the P&L. I should also note that remind everyone that you can't reverse impairment on goodwill. And the other thing to pick up on, like you said, you were talking about this before, but another key reminder, maybe outside of the financial statement, is if you book the initial impairment and make that adjustment through your non-IFRS measures, then you should also consider the reversal in those same adjustments if you're booking that in the current period.
Okay, thank you, Joe. I might stick with you also, and I think this came through when you were talking, I think about the timing, based on the OFR, but I think it's also maybe connected to your section at the back dealing with uncertain times. The question is, what does KPMG expect clients to disclose with regards to COVID impacts, given that, we've got high vaccination rates in Australia?
Yeah, thanks. For COVID impacts, I know we've been fairly lucky here in Australia with COVID compared to some other countries, but I would say that most companies will have some historical impact, and to the extent that they do have that impact, they should talk about, the impacts in their operating and financial review when discussing their historical results. When you think about the financial statements will contain some assumptions about the future impact of COVID. Those assumptions will be impacted by our high vaccination rates here in Australia, but there's still uncertainties such as future variants that probably none of us can fully grasp with how that might impact our organizations. So you need to think about that as well. So there may be more general disclosures where you're not able to come up with estimates there. But it's also important to remember that COVID has really shown how small our world is. So events and responses internationally also impact a number of organizations here in Australia. And an example of that at the moment is some of the restrictions that we're seeing in Shanghai, and other companies and cities have similar restrictions. So I would just say that we've been dealing with it for a long time, but there's still likely going to be some continued ongoing disclosure needed in the OFR and also the financial statements.
Okay. Thank you for that, Joe. Oksana, there's a question here on the new Australian financial reporting framework. The question is, are there any changes in relation to non-reported entities, such as privately held SMEs?
Yeah, sure. So firstly, I just wanted to reiterate that reporting and non-reporting entity concept does no longer exist in the new financial reporting framework. So which means if an entity does not have public accountability, then we will no longer assess whether the entity is a reporting entity as we used to do under the old framework. Instead, the question to answer here is whether an entity is required by legislation to prepare a financial statement in accordance with Australian accounting standards. So, for example, under the Corp Act. And if there is no such requirements, and I guess that's where we used to refer to non-reporting entities, for example, when there is a small proprietary company which is not controlled by a foreign parent. So for these type of entities, next stop is to look in the requirements of their constituting document, and where such document requires financial statement to be prepared in accordance with Australian accounting standards, then special purpose financial statements can no longer be prepared if this document was created or amended on or after 1st July 2021. So the change in the framework will impact many small proprietary companies as well, and will result in requirements for them to switch from special purpose to general purpose financial statements, simplified disclosures.
Okay. Thank you for that, Oksana. All right. There's a question here about BEPS. And the question is, if legislation is substantively enacted, do we need to consider raising any details for, I think it says 2022-23. So basically, this is a really complex tax. And the expectation is that BEPS Pillar 2 is actually going to be in the scope of the income tax standards, so AASB 112. And so therefore, if legislation, when legislation is substantively enacted, then deferred tax assets and deferred tax liabilities will need to be remeasured at these higher rates. I'm not expecting that Pillar 2 will result in new DTLs, but I am expecting that it will require a remeasurement of DTLs. Having said that, like I said, I did say that it's expected to be in the scope of the income tax standard. Globally, we've been having discussions with our counterparts in other parts of the world, and also with the other large firms. And there's general acknowledgement that deferred tax accounting for the BEPS 2.0 Pillar 2 tax is going to be very, very complicated. We'd be looking to issue additional guidance. There was also a possibility of approaching the IASB to get their perspectives on accounting consequences of BEPS 2.0. So that brings us to the end of our webinar today, and unfortunately we haven't been able to get through all of the questions, but we will answer them through your usual KPMG contact separately, so please watch out for that correspondence. Just wanted to say thank you for attending our webinar today, and I did see that the survey was pushed out, so before you leave the session, could I ask that you please complete our survey on how you found today's webinar and what topics you were interested in hearing about in the future, as we do use that information to inform our content going forward. And also a reminder that we are running part 2 of our webinar next week, so we're hoping that you will be able to join us next week. Until then, thank you.